Charles, over at Sovereign Financial Group, I know you talk a lot about sequence risk. So before we talk about how you combat it, what exactly is it?
Sure. So sequence risk is really the biggest risk that most people face with their investment portfolios. And not a concept that I came up with. As a matter of fact, John Bogle, the founder of the Vanguard Group, was really known for promoting it. And not promoting it that's a good thing, but promoting that you need to watch out for it. And it's without question one of the most damaging types of risks that's not completely, but it's not as addressed as it should be in many people's portfolios.
And who's most exposed to sequence risk?
Yep. It could be anyone that needs to withdraw money within 10 years is the best way I like to define that. So you'll see it most with retirees, because usually retirees are the ones that are drawing down their portfolios. But it could be someone that's looking to buy a house in 6 months, right? So let's say you have a young couple, they're not worried about retirement, but if they need to buy a house in 6 months, they are exposed to sequence risk. If that same young couple has a college-bound kid, as we were just talking about off camera, as I do, they're exposed to sequence risk. So anyone that's looking to withdraw money soon is exposed to it.
So is it a market problem or a planning problem? Would I rather be lucky or good?
Yeah, well, I'd rather be lucky, but I don't want to bank on that. So it's definitely a market problem, but there's nothing you can do about the market. So it becomes a planning problem, and that's exactly how you solve for sequence risk with proper planning.
All right, so what's a good way to mitigate sequence risk?
Yeah, it's really a two-step process. Step number one, you need to identify two things. How much money do you need and when do you need it? So the example we just had, let's say someone wants to buy a house in 6 months, educate a kid in 8 years, and retire in 20 years. What you want to do is create a discrete portfolio for each one of those. Your portfolio for the money that you need for a down payment in 6 months will be very conservative. Won't grow much, but it'll be very safe. The other side of that spectrum is your retirement that you don't need for another 20 years. That can and should be aggressive because you have enough time for the ups and downs to work themselves out.
So finally, one way people are trying to beat sequence risk is to use alternatives. Because they say, I'm not going to need this money till later, but sometimes they may need it. Something might happen in their family or in the market. So how do you make sure that people are liquid enough to beat sequence risk?
It all goes back to the planning. So in our shop, what we like to do is make sure we know for each client portfolio, we never talk in terms, we're going to manage the portfolio. Instead, we talk in terms of we're going to manage this subset of the portfolio that you need in 1 to 2 years, 3 to 5, 6 to 10, 10 plus. We happen to like alternatives as a way of reducing correlation to the public markets, but they do not belong in the 1 to 2 year subset. They do not belong in the 3 to 5 year subset, but somewhere between 10 to 20% in the 6 to 10 year subset and the 10 year plus is a great place to sprinkle in the alts, and that's going to bring down your volatility.
All right, well, thanks for coming on and talking about it.
Always a pleasure, Greg. Thanks so much.